Okay. Broadcast is now on there. Hi, everyone. Okay, so sorry we had to start over, but now Heath is going to talk. Take it away.
Thanks, Danielle. My name's Heath Alexander. I'm representative of SixUP. And SixUP was a company that was started by just a bunch of people who were the first in our families to go to college. And we came from family backgrounds with very limited resources. And so we decided to create a company for students who were like us. And what we mean by that is we got good grades, we worked hard, we studied hard, but we struggled to pay for college, and we struggled with accessing the higher education pathway in a way that was more cost effective for us. And so part of what SixUP is doing is trying to educate students about that pathway and understanding how to access it in a way that's going to be that they're going to be able to make best decisions about where they go to school and how they pay for it. Well, SixUP also created a low interest loan specifically for students who come from low income backgrounds and who may not be able to get a cosigner for a private loan to fill some funding gaps that they might have after their federal, state, and institutional aid is taken up. So we created a presentation paying for college and minimizing debt. And it's really talking about the higher education pathway. I like to call it pathway literacy, which is understanding better the decisions that you make along that pathway, how they can help you get out of college sooner, save money, and do it in the right way. So here's the presentation. We created SixUP because we were once like a lot of the students that we're going to be working with. And in particular, I'm going to tell a little bit about my personal story. I grew up in a very small rural town in Oklahoma called Ninnekah. Less than 1,000 people. Not too many people from my town thought about going to college when I was young. My mom actually had 3 kids at the age of 18 years old. She had her 4th kid at 22. And she was a single mom for most of our childhood. And most of our family members didn't get a high school diploma. Most of them didn't go to college. And so I became really the only person to go to college and get a bachelor's degree. For me, that was really important because I wanted to give back and help my family. And so I went to college and I started studying biology and chemistry. But while in college, it was difficult for me to afford it, given my family background, given the fact that we didn't have a lot of resources financially. And so I had to work full time. I worked in some semesters as much as 50 or 55 hours per week, working multiple jobs. And so I couldn't always take a full credit load. My grades oftentimes suffered, and it took me longer to graduate than most normal students would. You'd like to be able to graduate in a 4-year time period if possible, so you can save money. The more you go to school, the longer you go to school, the more you're going to have to pay for it. And I have a slide later that talks about that. But being the first in my family to go to college and the first in my family to get a college degree was really important for me. And so I tried to do everything I could to access that pathway. And the thing to me about getting a college degree that's most important is it really changes your future trajectory of your life, but also future generations. So because I have a college degree, it's much more likely that my kids will follow my footsteps and do the same thing. But most importantly, it creates a different dynamic between job and career. And so I just want to ask in the audience, what do you see as a difference between a job and a career?
Pay.
Pay, that's one of them. Anything else? Benefits, sure.
The work environment.
Okay, work environment.
Conditions.
Better working conditions, absolutely. Those are movement. Yeah, those things are all really, really important. One thing that's important to me about the difference between a job and a career and why it's so critical to get a bachelor's degree is that a career offers you more opportunity. Oftentimes jobs, which are very honorable and they're needed to be able to make money to help support your family, most people take a job because it's the only options that they have, right? Most people who have simply just a job took the job because they needed it, right? It wasn't a choice. It was like, I have to do this, I have to work, I have to make money. And a career is something you choose to do, right? It's a major that you go into in college. It's a job that you choose. And so getting a college degree opens up opportunities for you to choose the kind of field that you want to work in. And to me, that's the biggest difference between job and career. there are a lot of jobs that don't require a college degree that pay as well as some that do have a college degree. So pay in and of itself or benefits are not the only thing. To me, it's more about creating better opportunities for you to work the kind of jobs that you want to work and not just default to working what you have to do to get by to make money. To us at SixUP, college choice matters. Where you go to school matters. And the data suggests that students from low-income backgrounds do better when they go to better institutions. And so this chart just shows a very simple data that shows on the yellow graph, low-income students as they go to more selective colleges graduate on par with students from high-income families. In fact, when students from both socioeconomic backgrounds who are high achieving go to the most selective schools, they almost graduated at the same rate, 90% versus 91%. But as low-income students downgrade to less selective colleges, they don't fare as well. In fact, the graduation rate dips down below 60%, down to about 54%. So where you go to college does matter. The outcomes that you achieve from those colleges matter. And I don't mean just going to the most expensive school or the most popular one, or the school that's the most famous. I mean making the decision about going to college based on things that matter, like graduation rates of those institutions, like the ability to get a job from those schools, not just on the cost alone. And up-matching to better schools matters in terms of long-term output. You look at the lifetime median income from a student who goes to a tier 1 school versus a student who starts out at a community college or a tier 4 school who doesn't end up transferring and getting a 4-year degree. You earn 2 times more money over your lifetime. The 4-year graduation rates of students increases by 6 times depending on the tier of school that you go to. And then the default rate, the ability for you to pay or not pay the loans back that you've taken to pay for school, goes down 6 times based on the tier of school that you go to. So where you go to school absolutely does matter in terms of your long-term outcome. And so that's one thing we want to talk about today is where you begin accessing that pipeline, where you begin accessing your higher education pathway is really critical. Oftentimes people will tell students, yeah, you've gotten into 4-year schools, but it's really expensive. So we recommend you go to a 2-year college to save money. And while that might be a good route for some students, it's typically only a good route if you have a plan in place. And that plan includes knowing the school that you're going to be transferring to once you finish 60 credits at the 2-year school, knowing which classes you're supposed to take while you're at the 2-year school, and not taking too many credits while you're there that won't transfer to the 4-year university. Many students who go to 2-year schools take longer than 2 years to get their associate's degree before they transfer. And when they do that, they oftentimes use up too much federal financial aid eligibility before they transfer. And that's really important because you only get 6 years of federal eligibility for many financial aid awards, and there's a maximum amount of federal Stafford that you can take. So it's really important that if you are going to access the pipeline, the higher education pipeline through community college, that you have a long-term plan in place before you go there. And that plan includes a 4-year graduation plan or a 5-year graduation plan, depending upon what your major is, the first day you step foot on the 2-year college campus. So we look at different colleges differently, and these are just logos that we put in there, but it's important to segment out schools based on the 6-year graduation rates of those schools, based on the outcomes that you're going to get in terms of getting a job, being able to, to be in a better financial standing, so that you can make a better decision about how good the school is and cross-reference that by how much you're going to pay to go to that university. So for a high school senior or for a student who's at a community college who wants to transfer, it's really important to do an analysis of things that really matter about those institutions. Are students like you graduating when they go to those schools, and are they getting jobs upon graduation? Those are really important metrics to think about when you're selecting a college. SixUP is now launching a tool called Future Prime that's going to help students be able to better make that decision and better understand the difference between outcomes and cost. We want to help students know what the value is for attending institutions that they've been admitted to. So if you're interested, check out futureprime.com and a free resource that you can use to select a school. Most importantly, the message that I want to send is that you should never give up on your college dreams. And the reason why I want to send that message is because it's difficult. It's expensive. There are a lot of challenges. There are a lot of bumps and veering off the path while you're in school many times. It took me 6 years to graduate, but it was the best decision that I ever made. Unfortunately for me, I ran out of money and I ended up having to put tuition on a credit card because I couldn't get a cosigner from family to pay for a student loan. I couldn't get access to Parent Plus loan. I didn't have any money or any resources to help me gain access to paying for my last semester of college. And unfortunately, it did take me 6 years to graduate because of working full time. And so just like my advice to students about trying to have a 4-year plan, I lived the experience of running out of money, and it wasn't good. And the debt that I incurred because of that was credit card debt at a very high interest rate. And so that decision for me to work full time instead of go to school full time ended up costing me more money at the end of my college career than if I had just had a way to fund it on the front end and not have to work so many hours while I was still in school. And who knows what my grades would have been? Who knows, what opportunities would have come my way had I had a chance to actually study instead of work so much. But it's all good to have someone stand up and say, go to the best school, right? Like, it doesn't matter what the cost is, just figure out what your dream school is and just pursue that dream. But at the end of the day, the question still remains, well, how do I pay for that, right? It's not a cheap decision to go to school. So the question I have for the audience is, do you know what the cost is of college? Do you know what the average cost of an in-state public 4-year university is? Any guesses? What's the average cost of a 4-year public school in the U.S.? Just throw any number, whatever you can guess.
30,000.
30,000? Okay, that's close. The average is about 24,000 to go to a 4-year public school in the U.S. Some schools are a little bit less. Some schools are a little bit more, depending on where you live. In Texas, most 4-year public schools are around $18,000 to $23,000, 24,000. Yeah, absolutely. Yeah, those schools are all rough. Those schools are all under 25,000 a year to attend for total cost of attendance. But private schools range about 47,000. Again, these are just total cost of attendance. This is the price tag. This does not include all of the aid that you can get through filling out the FAFSA and through institutional aid or through state aid that you can get. So it's important that you don't just look at these numbers before you decide where you want to apply to go to school. It's important to apply and get admitted to your dream schools and then fill out the FAFSA on time to make sure that you can see how much aid you're going to get to go to these institutions. Because even though a private school is $47,000 on average, you might actually get more money to attend those schools than you might a public school, and vice versa. So it's important to know what your options are. Did you have a question?
Oh, no.
Okay. What's important to understand is that the decisions that you make impact you financially. Where you go to school, how long you stay in school, what you do while you're in school, what kind of experiences you get, whether you get internships, whether you study abroad, whether you join clubs, the network that you make, all of the decisions that you're making in school really impact your long-term finances. And I learned that the hard way. Now that you're in college, now that you're out of your parents' home, you're living on a campus, it's up to you to make these decisions, right? You're now an adult and you now need to take control of the plan, not only where you're going and what classes you're taking, but you also need to take control of financing that, right? It's your responsibility to figure out how to make decisions about paying for school. What I encourage students to do is to be creative. Find ways to look for scholarships that are available. Find resources on campus that you can access. For example, you can apply to be a resident assistant in the dorm, and oftentimes schools will waive your room and board to be an RA on campus. So think about those kind of things. Also, be a self-advocate. Most of the time, people are not going to come knocking on your dorm room offering to give you scholarships or offering to give you additional money. If you get an award letter from a university and you're not satisfied with it, or you feel like you can't cover the cost of whatever remaining gaps that you have, it's okay to go back to the financial aid office and set up a meeting and say, is there some additional re-awarding financial aid money that I could gain access to? Are there more grants that I could apply for? Do you know about some scholarships? it's really important to go back to the financial aid office to see if there's some additional funds that you can get through the process. It can't hurt to ask, and certainly they're not going to come, begging to give you money. You're going to have to go advocate for yourself. Be resourceful. Again, and I think that also goes along with being responsible. Especially students who live off campus, oftentimes students will get their financial aid award letter and they'll get a refund check that's supposed to be used to buy books and supposed to be used to pay for your apartment and supposed to be used to pay for your food. You need to be responsible for that money. You can't spend that on things not related to college. It's supposed to be related to your total cost of attendance. If that money's used up, you can't get additional aid to pay for school because you've already utilized all of that aid for your total cost of attendance. So you have to be responsible and resourceful about how you manage that money. If you're not good at managing money in a financial sense, you need to seek out resources that will help you budget it a little bit more. This presentation isn't as much about budgeting as it is about how do you pay for college in general and what the pathway looks like. But there are a lot of resources that can help you manage your budget and manage that money that comes in for you. But again, you have to take control and you have to be responsible and resourceful about how you spend that money, especially if you live off campus and you're getting a refund check. But most importantly is to be on time. And what I mean by that is you need to be on time in filling out the FAFSA. And that should be easier now, right? FAFSA now, you can now start filling it out on October 1st. You can now use your your parents' prior tax returns in order to fill out the FAFSA. And so it's now easier to be on time to fill it out. But it's really important to be on time because if you don't fill it out on time, you don't get access to the same amount of money that you would if you fill it out late. Also, SAP is called Satisfactory Academic Progress. Each institution sets its rules around how you make satisfactory academic progress. If you don't make satisfactory academic progress, you cannot continue to keep getting federal aid to pay for school. Oftentimes, that means that you need to be at least 3/4 time in college. You need to be able to pass 75% of your coursework. You need to maintain at least a 2.0 GPA or above. Again, these are just general rules, but you need to check with the institution that you're attending to find out what their rules are because they're different across various institutions. But satisfactory academic progress ensures that you'll be able to continue to get federal funding to pay for school. And then also be on time in terms of graduating. College is the best time of your life. It's the freest you're ever going to be. It really is an amazing time if you make it that way. And so a lot of students just say, why do I need to rush? Why do I need to get out of here? Like, this is really a great time for me. And so, they don't focus on their studies. They have to end up retaking classes, or they withdraw from classes and drop below full time. And oftentimes they take longer than 4 years to graduate, and that's really expensive. And so you have to understand what are the consequences for those decisions that you're making to not graduate on time. So we created a little chart that gives you just some sense of the financial consequences of that decision of not graduating in a timely way. So this chart is just called the cost of delayed graduation. And so you look at if the average cost of a 4-year public school is about $24,000 a year, you're spending about $96,000 over a 4-year time period. That's when you're expected to graduate. If it takes you 1 more year to graduate, you've just spent $24,000 more than you had to spend on your tuition, on your cost of college. But more importantly, you just missed out on a year's worth of lost wages if you had graduated a year earlier and gotten a job. And so we just said, for example, what if you got a job making $40,000 per year? If it took you 6 years to graduate, you just spent $48,000 more dollars on college than you had to spend, and you just lost out on $80,000 of lost wages from 2 years of not working. So if you start to think about these decisions and you think about this pathway, there is a better, smarter pathway, a cheaper pathway that you can take to get through higher education and get your degree. And there are severe financial consequences for not taking that pathway seriously and not trying to be on a 4-year schedule. Lots of things get students off the 4-year schedule. For me, it was I just had to work too much to stay in school. I didn't have a way to get money that would allow me to not have to work so much based on my family's financial situation. So If I had an opportunity, I might have, taken that opportunity to not have to work so much, and maybe I could have graduated it in a 4-year time period. So really important concept that the decisions that you make have financial consequences for you. So again, how do you pay for college? Well, there's some free money, and those of you who are listening online and those in the audience probably know about some of that free money. What's an example of some free money that you might have received to go to college?
Financial aid.
Some financial aid. Can you name something from there?
Scholarships, grants.
Scholarships and grants. Good. Those are two good examples of free money. And some of them you're able to get simply by filling out the FAFSA. And the FAFSA is the free application for federal student aid that every college student should fill out, and you should reapply each year and reapply on time. The maximum Pell Grant, actually last year was $58.15, now it's $59.20 for this upcoming school year. So just for filling out the FAFSA, and just because your family's income is below a certain threshold, you're able to get access to something called a Pell Grant.
What's that amount?
So what the FAFSA does is it calculates something called an EFC, and EFC stands for expected family contribution, and that's the amount that your family is asked to pay for your college, your cost of college. If your expected family contribution is 0, based on the formula that the federal government creates, then you're able to get the maximum amount of the award. If your expected family contribution, as it goes up, your Pell Grant potentially goes down. And so it's based on your financial need, based on your family's income. So Pell Grants are really important because what free money means is you don't have to pay it back. It's not a loan. It's money that's given to you by the federal government to help supplement your family's income so that you can afford to go to school. So really, really important that you always fill out the FAFSA and you access Pell Grant. But another option that students have to use to pay for college are loans. And so I'm going to talk about the different kind of loans, and I want to get you to understand that a lot of students don't want to take loans, and sometimes we fear what that means for us. But I think it's really important to understand that with the cost of college and with the limited financial aid available, oftentimes students do have to access both federal and often sometimes private loans to be able to pay for their entire that entire cost of college. Again, if the average school is almost $100,000 for you for a 4-year time period, you can understand that some of that is going to be self-help. Some of it's going to be you're going to have to work to come up with it. You're going to have to take a loan. So the question is, what percentage of students, roughly, it's not an exact number, but about how many students nationally have to take out loans to pay for school? Do you have any idea? 60%? Okay.
22%.
Huh? 20. Okay, very close. The average is roughly around 70, give or take. In any given year, it might be different. Yep. So most students who go to college are going to have to take out some form of loans, whether it's a federal loan or a parent loan or a private loan. And so the overall point here is you shouldn't be scared of the loan system, especially the federal loan system, because it's how most students pay for college. So it's not whether I should or shouldn't take loans. It's about which loans are the best for me to take. That should be a little bit more about the approach and how do you keep that debt load as low as you possibly can. Obviously, from the previous screen, as I mentioned, one way to keep that debt as low as possible is to take your courses seriously, pass all your courses, go to class, and graduate in 4 years. That's the best thing you can do to keep your debt as low as possible. What do you think the average student graduates with in total loans upon their college graduation? What is the average what's the average debt students have when they graduate from college? 20,000? Okay. Any other guesses? 60,000? Any other guesses from the crowd? 30,000? Ding, 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 ding. Actually, the average student takes roughly around $30,000 of student loans to get their college degree. Yeah, just average student. And a lot of that is federal loans, which are really good loans to take. So I want to talk about a couple different types of loans. The Stafford subsidized loan is probably the best loan you'll ever be offered in your lifetime. And the reason is that it's really low interest rate. based on the federal government's rates that can change on a regular basis, anywhere from 3.7 to 4.2% around that range. So again, the interest rate is really low on them. But more importantly, the federal government currently offers something called the Stafford subsidized loan. And what subsidized loan means is that you are not gaining interest on that loan while you're still in college. So if you borrow $10,000, when you graduate in 4 years, you'll still owe exactly $10,000. The interest is not, the clock on the interest is not running while you're still in school. So again, even as an adult, to buy a house or a car loan or any of that kind of stuff, it's not likely you'll ever be offered a house loan or a car loan that for 4 or 5 or 6 years doesn't gain any interest, right? Like those loans are not really available. And so this is a really good loan to take if you need to take one. They also offer the Stafford unsubsidized loan. Again, same interest rate, still a good loan, still a federal loan. The only difference about it is that it does start getting interest while you're still in school. Currently, a student incoming freshman would get about $2,000 offered to them, depending on their financial aid package, and could receive more unsub loan if some other factors that I'm going to talk about later apply to you as well. But the basic student would get about $2,000. Again, there are other types of loans that I want to talk about, and I want to compare them so you can understand the differences between them. The federal direct Stafford loans are based on your financial needs. So again, you fill out the FAFSA, you get your EFC, your expected family contribution, and then you get offered the award based on your family's income, your family's financial situation. That's different than a private loan, which is typically based not on your family's income, but based on your family's credit history. And your credit history in general, and a simple way to say it is your family's past history of managing money and managing debt and paying off their bills, right? Paying things on time. And so, oftentimes families like mine have a difficult time paying bills on time on a regular basis. And so oftentimes our credit history is not as good as somebody who makes a lot more money who can pay those bills more readily. And so sometimes private loans are hard to access for families like mine because we don't have a good credit history, or as a student, I wasn't able to get a cosign. So the most important difference between the federal loan and a private loan is one is based on financial need and the other is based on your family's credit history. It's a really important distinction. I want to make another comparison between the federal Parent Plus loan and the private loan and other private loans. The federal Parent Plus loan is actually applied for by the parents of the student who's going to college. The parent receives the loan and the parent pays the loan back. This is also based on your family's credit history. So your parents still have to apply for the loan and they still have to use their credit history in order to qualify. If you are denied the Parent Plus loan, you can automatically receive additional Stafford unsubsidized loan to be able to pay for college. If you are accepted for the Parent Plus loan, the parents either have to accept that loan or they have to seek outside private funds, maybe at a bank or some other private lender. And so both of those are based on credit history. But a private loan, if the student is applying for it, oftentimes a college student doesn't have any credit history because you haven't accessed credit before. And so you will more than likely are going to need your parent to co-sign for you to get a private loan yourself. Most teenage or young people who are in college won't be able to get a loan without a co-signer because they don't have any credit history themselves. But both loans are based on credit history, not based only on financial need. That's really important. In the introduction, I mentioned that SixUP created some low interest loans for students like me, and I want to make a distinction between Parent Plus loan and the SixUP loan. Again, the Parent Plus loan is a loan to the parents, and it's based on credit history. With SixUP, we created a loan that's not based on family's credit history and not based on credit score. It's really based on the student's hard work. And what I mean by that is we created an underwriting system based on academics. So students can qualify for a SixUP loan by getting good grades. And you don't need a cosigner from your parents, and your parents don't have to apply for the loan for you. The student can qualify on their own with their own hard work and academics. So again, just a little bit of a nuanced difference between what we're doing and what another private loan or what the Parent Plus loan would look like. And so in many ways, if a student or the student's family doesn't want to apply for a loan, or they don't want to apply for a Parent Plus loan or can't co-sign, SixUP loan may be a better option for you because you can qualify based on your own academic background. Any questions about that? Okay, understood. So why am I bringing up the comparisons, and why am I bringing up credit history and credit scores? That's because our financial system really weighs heavily on whether you have a good credit score or not. But a lot of people don't understand the credit system, and they don't understand FICO scores, or they don't understand what goes into making up a FICO score. A lot of people don't track their credit history, and they don't track their credit score. So a lot of people don't even know what a good score might be. So I do know we have someone in the audience who's really good at understanding his credit, and he actually knows his credit score. So I want to just ask a question. Do you know what a good credit score is? What would be a good credit score? Like, what number would be a good number for a credit score?
Well, good is considered between 690 to like 750.
Okay. Good. So after 690 all the way up to about 850 would be an excellent credit score, right? That would be a really good credit score. Anything below that starts to get a little bit, more difficult to get private money, and your interest rates on that private money goes up as your credit score goes down. So the range, between 300 and 850, depending on which credit score it is the range. Anything below 650, you're going to start getting a much higher interest rate and a less likelihood of getting funded. So what goes into making up a FICO score? That's something that really a lot of people don't understand. And it's a complex system, but there are really 5 key factors that make up most credit scores. And so I'm going to talk just briefly about what makes up a FICO score. The first and most important thing is your payment history. Are you paying your bills on time? Do you have a long history of always paying your bills each month full? That's really, really important. Roughly 30-35% of your FICO score comes from paying your bills on time. So that's really important. I think that's probably the most obvious. I think most people know that you have to pay your bills on time or it can hurt your credit. But I think it's important to mention that that's really critical. The second is credit utilization. And what that means is, of the credit that has been extended to you, how much of it have you used up? Sometimes we call it maxing out, right? People have talked about, I maxed out my credit card.
Gotta use 10% only.
Maxing out your credit card is bad. Having only 10% is really good. And really, you'd like to stay under 30% utilization. So if you had a $10,000 credit card, you want to not charge more than $3,000 on it at any given time. So you want to stay under that 30%. 10% is better, but anything over 30% starts to negatively impact your credit score. So you'd like to have more credit available to you and use as little of it as possible. And certainly you'd like to pay it off at the end of each month if possible. The other thing that impacts your credit score, not as much, but it does impact your score, is the length of credit you have available to you. So if I've opened a credit card, but I've only had that credit card open for 6 months, there's only 6 months worth of payments for you to be assessed on. They only know if you're able to manage your credit for 6 months. If you have credit available to you for 20 years, they have 20 years of history to see how did you manage your credit and how did you pay those bills over that long time period. So the longer the credit's open to you, the higher your score becomes, the more impact it has on you. Now, of course, for a young person, this is hard because you don't have any credit, and it's hard to get credit unless you have some, and it's hard to get that credit system started. So, trying to get a little amount of credit card available to you that you use it on a regular basis and pay it off consistently is a good thing to do. Maybe trying to get your cell phone in your name and paying that bill on a regular basis. Eventually, you're going to start building some credit history, and you're going to start building your credit. So you need to have credit open available to you for a long time. And what's important about that is you don't want to open up lines of credit and close them consistently. If you open up a line of credit, keep it open as long as you can and use it periodically and pay it off each month every time. It's not good to open a bunch of credit cards and then close them. The second thing is another reason why you don't want to open and close a bunch of credit cards is one thing that impacts your credit are inquiries or new credit. Every time you apply for credit, every time you apply for a loan, whether it be a car loan or a credit card, it shows as someone is making an inquiry on your credit report, and you want to try to stay below 3 of those on any given year. If you do more than 3 in a year, it starts to negatively impact your credit score. So again, you don't want to just apply for a bunch of stuff because people offer it to you. You know, when you go to a department store and you're buying clothes, they always say, hey, if you open up a credit card today, you can save 20% on your purchase. Oh, that sounds great. I'd love to save 20%. But every time you do that, it's an inquiry on your credit, and it starts to hurt your credit. Which also relates to the next topic, which is types of credit. Some credit is seen as good, some credit is seen as bad, right? You know, taking out a car loan or a student loan or a house loan, you know, that's good credit. Taking out a bunch of credit cards at department stores is bad credit, because what are you paying? What are you using those credit cards for, right? If you have a credit card from Macy's, they know what you're going to buy with that. You're going to buy clothes. You're going to buy things that are material possessions that don't last, right? Like they don't have any value after you buy them, and especially after you wear them for a while. So you're using credit to buy things that are, that are essentially perishable things. I'm going to talk about good debt versus bad debt. Debt is negative. It has a negative connotation. People say, oh, I'm in debt. I don't like to be in debt. I don't like to pay off these bills, right? Debt in some ways is a necessary aspect of life in the U.S. Most people don't have hundreds of thousands of dollars in cash to buy a house. Most people who buy houses take out a home loan and pay off that home loan. Most people don't have tens of thousands of dollars to buy cars. Most people have a car note that they're paying on a regular basis. And the same with college. Most people don't have $100,000 sitting in the bank to just pay 4 years of college. And so oftentimes we have to borrow to pay for these things. But that's good debt. Those are good investments to make because they have positive impact on your life. But also there's bad debt. What things should you not go into debt for? What things should you pay cash for instead of going into debt? Certainly you don't want to be charging a bunch of food, a bunch of vacations, a bunch of clothes, a bunch of things that after you use them really don't have much value, because now you're going to be paying for years to come on things that you can't use anymore. And so that's understanding good debt versus bad debt is really key to this. And so some people say, well, how do you end up getting good credit? Again, the key is to use your credit wisely and to manage it in a way that you're not over borrowing. You're not over borrowing for college. You're not over borrowing for a house that you can't afford. You're not buying the most expensive car when you know you can't afford it. You're not charging a bunch of things on your credit card knowing that you'll never be able to pay it off at the end of the month. That kind of stuff is what gets you into trouble. That's what makes debt seem like it's such a bad thing, because many people don't know how to manage it. They just charge and charge and charge, and they're not monitoring it, and they know they're not going to be able to pay this back at the end of the month. And so people get deeper and deeper into debt. And so that's why it has such a bad name. But don't be scared to take out a student loan to pay for your college degree that's going to give you a better trajectory in life, that's going to get you a chance for a better career, just because debt in itself has a bad name. So just like all of this bad debt, college debt is bad if you don't get your degree, right? So going for 2 or 3 years and taking out a bunch of student loans and not graduating just because you don't want to take one more loan is a bad decision, right? Like, get the college degree at all costs at that point, because if you don't, now you've got all these college loans you have to pay off and no way to pay them and no way to get a career. So really important. But how do you make that decision? Just kind of an ending, winding down the presentation. A lot of people say, well, how do I know what's good and what's bad, and how do I know when to take out debt? So for me, I just have a simple rule. When debt is paid off, you should be able to answer these 3 questions. The first is, will I remember what I bought once I've paid it off? Will that item still have value? And number 3, will the total cost plus the interest I pay be worth taking debt for that? If you can answer yes to both of those, then I think it's okay to borrow. But if you answer no to any one of those, you should do what you can to pay cash. So I like to use the example Fortunately, GenesysWorks brought pizza in tonight for those in attendance. So I like to use the example of pizza. If you kept putting pizza on a credit card all through college and you racked up thousands of dollars of debt in pizza, then you ask yourself these 3 questions. Will I remember the pizza I bought 4 years ago, right? I probably won't remember that pizza. Will that pizza still have value 4 or 5 years from now? No, it doesn't have any more value, right? It's already out of our system. We're not getting any nutrients from it. It's not benefiting us in any way. And will the cost of that $20 pizza 5 years later that now has cost me $80 be worth the value that I spent on that pizza? So really the answer to all 3 of those questions is no for charging food. And so I think that's an easy thing to talk about. But a lot of students are adverse to taking out debt to paying for college. So I like to go through these questions about college debt. And again, I'm not advocating for just going into massive debt. I'm advocating for responsible and responsible debt management for paying for college. But I talk to a lot of students on a regular basis who refuse to take any loans and who aren't eating well and who can't pay their rent and they're sleeping on people's couches and they're working 50 hours a week and they're failing their courses and they're making all these bad decisions because they fear the debt. And so what I want students to do is be responsible at managing it. But if you think about student debt and you ask these 3 questions, will I remember going to college, right? Will I remember the debt of paying for college? Yeah, of course you're going to remember your college time. Again, for me, it was the best time of my life. Number 2, will your college degree have value? Of course it's going to have value, right? You're going to have access to jobs, or at least you're going to have a better opportunity to get a career and to be able to be employed than if you don't have a college degree. College graduates make over $1 million more over a lifetime than a high school graduate. So there's huge value in getting a college degree. I know that, some people talk about, college doesn't guarantee you a job. Of course it doesn't guarantee you a job, but you're far better off with a college, especially a bachelor's degree, than you are with a high school diploma. There's no debating that. And then number 3, will the total cost plus the interest be worth it to get your college degree, to get a bachelor's degree? And so I think the answer, again, unequivocally is yes. And so I think it's okay to borrow to go to college. I think it's okay to borrow to, to buy a house, a responsible house for you and your family. So in conclusion, the pathway that you take through higher education is important. There's a series of decisions that you're going to have to make. And each of those decisions will have some kind of financial consequence or implication for you long term. What oftentimes we do is we make short-term decisions. We just say, how can I pay for this semester? How can I pay for this year? How can I go to the cheapest school so that it costs me the least amount of money? And oftentimes that pathway is longer for students. And so I like to use an analogy of just taking a trip. Let's say you wanted to drive to California, or where our SixUP office is. You want to take a trip to San Francisco. Someone say, well, look at the plane tickets. They're $600. Like, that's a lot of money. Why don't you just drive there? It's cheaper, right? And so there's a path that you would take to get to San Francisco. And while $600 is a lot for a plane ticket and driving might be cheaper, what happens along that pathway can dictate whether it's cheaper or not, right? You might have your car might break down. You might have a flat tire. You might get tired of driving and have to stay in a hotel, using up a lot of gas. You've got to buy food all along the way. It's going to take you 2 or 3 days to drive there. You're going to be exhausted. There's a lot of dangers out there, right? So there's like a lot of twists and turns and mountains and hills to climb. And so while someone might think it's cheaper, it takes you longer to get there. And there are a lot of ways in which you can fall off that pathway along the way. And that's the same with college. Just trying to look at what might look like a cheaper option up front may end up being a more expensive option later. If you do what I did, which is take 6 years or 7 or 8 years to graduate, by the time you get there, you might not make it. And you're also going to end up having all of that cost of college be debt or be loans at the end of that, as opposed to just trying to go on that 4-year route. So again, every decision that you make matters, and there are financial implications for that. And so you have to take ownership over that plan. And SixUP has your back along that plan. We have a way to help you fund college in a smarter, better, and a cheaper way. And so if you do need help paying for college, certainly we're here to help you. So thank you so much. Appreciate it. I got a standing ovation for those of you online. The big crowd we have here at the GenesysWorks. Oh, and the wave for the GenesysWorks office.
Thanks everyone for tuning in.